There is a secret language spoken by the world's wealthiest individuals. It's not a language of frantic stock charts, complex algorithms, or breathless speculation about the next big thing. It is a quiet, patient language. A language of ownership, of permanence, of unshakable reality. It's a language that Warren Buffett mastered decades ago. A language that allowed him to transform a small textile mill in New England into a global financial fortress. And the core grammar of this language, the foundational sentence upon which his entire empire was built, is a simple, profound idea. Stop chasing shooting stars and start buying toll bridges. Imagine, for a moment, you own the only bridge into a thriving, essential city. Every car, every truck, every person who needs to get to the other side has no choice but to cross your bridge and pay your toll. You don't care about the weather. You don't care about the daily headlines or the political squabbles. You don't care about what new model of car is popular this year. All you care about is that the city remains essential and the river remains difficult to cross. Day after day, year after year, the coins just keep dropping into your collection box. This isn't just a metaphor, it's a mental model, a blueprint for a kind of financial freedom that is almost unimaginable to the average person, the person who spends their life gambling on maybes and what-ifs. The costly mistake that this principle prevents is the siren song of the new, the trendy, the unproven. It saves you from the gut-wrenching experience of pouring your hard-earned capital into a company that is the darling of the media today, only to watch it be displaced by a slightly better, slightly cheaper, slightly newer version tomorrow. It stops you from becoming a victim of the endless cycle of market hype and market despair. The financial transformation that occurs when you adopt this mindset is profound. You cease to be a speculator, a gambler nervously watching red and green numbers flicker on a screen. You become an owner. You develop a calm, discerning eye for identifying businesses with such an iron grip on their market that competition is a mere afterthought. This leads to a portfolio that isn't just a collection of tickers. It's a collection of cash-generating machines, each one a metaphorical toll bridge, working to provide you with a predictable, ever-growing stream of income, year after year, decade after decade. This is not a get-rich-quick scheme. It is the blueprint for getting rich forever. The first and most crucial pillar of this entire philosophy is understanding what makes a toll bridge truly a toll bridge. It is the principle of essentiality. We call it the irreplaceable toll bridge. This isn't just about a product people want, it's about a product or service people feel they need. It's woven into the very fabric of their lives, their habits, their emotions. And there is no better story to illustrate this deep, intangible power than a story about something as simple and wonderful as chocolate. In 1972, Warren Buffett and his partner, Charlie Munger, were presented with an opportunity to buy a company called See's Candies. On the surface, it looked like a decent but unspectacular business. It was a chain of candy shops based primarily in California, known for its old-fashioned, high-quality chocolates. The asking price from the See family was $30 million, but Buffett and Munger, through their holding company Blue Chip Stamps, were only willing to offer $25 million. The See family accepted. For Buffett, even at $25 million, the price felt steep. At the time, the company had about $8 million in tangible assets, things like stores, equipment, and inventory. This meant they were paying a $17 million premium for something that didn't appear on the balance sheet, something intangible called goodwill. This went against every fiber of Buffett's early training under his mentor, Benjamin Graham, who taught him to buy businesses for less than the value of their hard assets, so-called cigar butt investing. Paying a huge premium for a brand name felt speculative, almost reckless. He was deeply hesitant. But Charlie Munger saw something else. He saw the irreplaceable toll bridge. Munger understood that See's Candies wasn't just selling chocolate. It was selling nostalgia. It was selling tradition. It was selling the perfect, reliable gift for Valentine's Day, for Mother's Day, for Christmas. When a young man went to meet his girlfriend's parents for the first time, he brought a box of C's. It was a social lubricant, a signal of good taste and tradition. Trying to save a few dollars by buying a generic box of chocolates from a supermarket wasn't just a financial decision, it was a social risk. The customer wasn't thinking, how can I get the cheapest chocolate? They were thinking, how can I show my affection and make a good impression? C's candies had become the answer to that question for generations of Californians. Munger convinced Buffett that this emotional monopoly was the company's true asset. The physical stores were secondary. The real value was the real estate the brand occupied in the customer's mind. They went ahead with the $25 million purchase. The results were nothing short of astonishing. Over the subsequent decades, C's Candies, a business bought for $25 million, would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all without requiring significant new capital investment. It was a gusher of cash. Buffett himself would later say, if we'd have been a little smarter, we would have paid the $30 million the family was asking for. The $17 million premium for goodwill turned out to be the greatest bargain of all. C's Candies taught Buffett the most important lesson of his career. The most powerful toll bridges are not always made of steel and concrete. Sometimes they are built from memory, emotion, and habit. The reason a business like C's Candies can exert such power over its customers lies deep within our own psychology. The underlying principle at work here is a combination of the habit loop and emotional resonance. Our brains are fundamentally lazy. They are designed to conserve energy by creating shortcuts for routine decisions. Charles Duhigg, in his book The Power of Habit, breaks this down into a simple neurological loop, a cue, a routine, and a reward. For a C's customer, the cue might be an upcoming holiday or a special occasion. The routine is to drive to the familiar black and white C's store. The reward is not just the delicious chocolate. It's the feeling of relief, of having found the perfect gift, of fulfilling a social obligation, and the warm, nostalgic feeling the brand evokes. Every time this loop is completed, the neural pathway in the brain strengthens, making it more and more automatic. To switch to another brand would require conscious effort to break this deeply ingrained habit. But it goes deeper than just habit. It's about emotional resonance. We don't make decisions, especially purchasing decisions, based on pure logic. We are driven by emotion. C's Candies isn't selling a commodity. It's selling an emotional experience. The brand is anchored to positive life events, birthdays, anniversaries, celebrations. This creates a powerful association in our limbic system, the part of the brain that governs emotion and memory. When a customer buys C's, they are, on a subconscious level, reliving those positive emotions. The purchase triggers a small release of dopamine, the brain's pleasure chemical, not just from the thought of eating the chocolate, but from the act of purchasing this specific, trusted brand. This emotional connection makes the product's demand highly inelastic, which is a technical way of saying people will keep buying it even if the price goes up a little. A 5% price increase on a box of chocolates that represents love and tradition is insignificant. The emotional cost of switching to a cheaper, unknown brand feels far higher. This is the psychological foundation of an irreplaceable toll bridge. The business becomes part of the customer's identity and life story, making it almost unthinkable to use an alternative. So how can you, as a retail investor or an entrepreneur looking to build a durable business, apply this principle? How do you develop the CEO mindset necessary to distinguish a truly essential business from a fleeting fad? You need a practical mental model, a blueprint. Let's call it the indispensability test. It's a 4-part filter you can apply to any company you are analyzing for a long-term investment. Step 1 is to ask the pain of substitution question. If this company and its products vanished from the earth tomorrow, how much genuine pain and chaos would it cause for its core customers? Be brutally honest. If a social media app disappears, people will be annoyed for a week and then migrate to the next one. The pain is minimal. If the company that runs the electrical grid disappears, society grinds to a halt. The pain is catastrophic. If your local waste management company stops picking up the trash, the pain becomes very real very quickly. You are looking for businesses on the higher end of this pain spectrum. A business that solves a deep, recurring, and painful problem for its customers is indispensable. Step 2 is the generational test. Has this product or service been considered essential for more than one generation? And more importantly, is it highly probable that it will still be essential for the next generation? Coca-Cola has passed this test for over a century. People's need for fast, reliable insurance has existed for generations, which benefits a company like Geico. The need to transport massive quantities of goods across the country has been essential since the dawn of the railroad, benefiting BNSF. This test helps you avoid businesses built on temporary technological trends and focus on those that serve fundamental, unchanging human needs. This is the heart of long-term investing. Step 3 is what I call the boring test. Is the business itself mind-numbingly simple and boring? This is a surprisingly powerful indicator. The most essential businesses are often the least exciting to talk about at a cocktail party. Nobody wants to hear about the intricacies of railroad track maintenance, municipal bond insurance, or the manufacturing of brick. But these boring businesses are often the most durable. They don't attract a flood of brilliant venture capital-funded competitors trying to disrupt them, because the work is unglamorous. They just quietly go about their business, collecting their tolls year after year. A portfolio of boring, indispensable businesses is the secret to a stress-free path toward financial freedom. Finally, step 4 is to analyze the frequency of purchase. How often do customers need to pay the toll? The best toll bridges are those that are crossed frequently. We pay our electric bill every month. We buy our favorite brand of toothpaste every few months. Businesses use Microsoft Office every single day. This high frequency of purchase creates a smooth, predictable stream of revenue. It's the difference between a company that sells a product once, like a home builder, and a company that sells a service over and over again, like a utility. By applying this 4-part indispensability test, you begin to see the world through a new lens, filtering out the noise and focusing only on those rare businesses that are truly essential. To fully grasp the power of this approach, we must examine its opposite. We must walk the path of the 99%, the path littered with financial ruin and shattered dreams. This is the path of shiny object syndrome. The average investor is constantly chasing what is hot, what is new, what is being breathlessly discussed on financial news networks. They are drawn to complexity and promises of explosive, overnight growth. The perfect illustration of this folly is the dot-com bubble of the late 1990s. It was an era when the old rules of business were declared obsolete. All you needed was a plausible-sounding idea, a .com at the end of your company name, and an ever-gullible public ready to throw money at you. Profitability was a quaint, outdated concept. Eyeballs, user growth, and mindshare were the new metrics. Consider the legendary tale of Pets.com. The company had a charming, sock puppet mascot, a catchy slogan, and a Super Bowl commercial that cost over $1 million. They were going to revolutionize the pet supply industry by selling dog food online. The company went public in February 2000 and raised $82 million. Investors clamored to get in on the action. But they had missed the most basic question of the indispensability test. Did Pets.com solve a painful problem? The answer was a resounding no. They were selling heavy bags of dog food and trying to ship them across the country. The shipping costs often exceeded the profit margin on the product itself. They were losing money on every single sale. There was no essential service here. They were just a middleman setting money on fire. The company burned through over $300 million of investor capital in less than 2 years. By November 2000, just 9 months after its IPO, the company was bankrupt. The stock was worthless. The sock puppet was retired. This story was repeated thousands of times. Companies like Webvan, which promised to revolutionize grocery delivery, and eToys, which aimed to dominate online toy sales, all followed the same tragic arc. They were exciting, they were new, and they were utterly non-essential. They had no durable competitive advantage, no real grip on their market, and no path to profitability. People who invested in them weren't buying toll bridges, they were buying lottery tickets. And as with most lotteries, almost all of them ended up being worthless pieces of paper. This is the path of the 99%, a constant, stressful chase for the next big thing, leading to a portfolio built on sand, ready to be washed away by the first tide of economic reality. The financial consequences of focusing on essentiality are not abstract. They manifest directly and powerfully on a company's financial statements and, consequently, in your investment portfolio's performance. When you identify a business with an irreplaceable toll bridge, you will see a set of distinct financial signatures that separate it from its more speculative peers. The first and most obvious is the stability and predictability of its revenue. Look at the top line, the total sales of a company like Waste Management or a utility like Consolidated Edison. You will notice that their revenues don't fluctuate wildly with the economic cycle. Even during a deep recession, people still need their trash collected and their lights kept on. This creates a baseline of demand that is incredibly stable, providing a foundation for predictable income. This is the bedrock of a successful passive income strategy. Second, look at the company's gross margins. Gross margin is the percentage of revenue left after subtracting the cost of goods sold. A company with an essential product and little direct competition doesn't have to engage in vicious price wars. See's Candies doesn't need to offer 2-for-1 specials to get people in the door before Valentine's Day. This ability to maintain pricing gives them consistently high gross margins. A commodity business, like a basic steel manufacturer, will have its margins squeezed every time a competitor tries to undercut them. A business with an essential, branded product has a buffer. Third, examine their spending on sales and marketing as a percentage of revenue. Businesses with truly indispensable products often have surprisingly low marketing budgets. The product's necessity and ingrained habit in the consumer's life do most of the selling. Coca-Cola still advertises to reinforce its brand, but its marketing spend is a fraction of its massive revenue base. Compare this to a new tech company trying to break into a crowded market, which might spend 50 cents or more of every dollar of revenue just on acquiring a new customer. This efficiency flows directly to the bottom line, increasing the cash available for owners. Finally, this all culminates in consistent profitability and cash flow. A business that enjoys stable revenues, high margins, and efficient spending will almost invariably produce a reliable stream of earnings. This isn't the explosive, unpredictable growth of a startup. It's the steady, dependable growth of a mature, dominant enterprise. For an investor, this translates into a low-stress, high-performance portfolio. You aren't praying for a miracle. You are simply collecting the tolls from a well-positioned asset, building your wealth methodically and surely on a foundation of real-world necessity. Once you have identified an essential business, a true toll bridge, the next layer of analysis is to understand what keeps competitors from simply building another bridge right next to yours. This is the second pillar of the Buffett philosophy, the unbreachable moat. A toll bridge is only valuable if it is a monopoly, or at the very least part of a small oligopoly. A durable competitive advantage, or moat, is the structural feature of a business that protects it from competition, allowing it to earn high returns on its capital for very long periods. Without a moat, even the most essential business will see its profits competed away. The perfect story to understand the power of a moat, particularly a brand-based one, is the story of Warren Buffett's investment in American Express during the salad oil scandal. The year was 1963. American Express was a respected company, known primarily for its travelers' checks and its relatively new charge card, which was a symbol of prestige and affluence. But a crisis was brewing. One of its clients in its warehousing division, a company called Allied Crude Vegetable Oil, run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had secured huge loans using his inventory of salad oil as collateral, which was stored in American Express's warehouses. The problem was, the tanks were mostly filled with water, with only a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and its lenders, who were owed the equivalent of over $1 billion in today's money, turned to American Express, claiming they were liable since they had certified the inventory. Wall Street panicked. The fear was that the liabilities from the scandal would wipe out the company entirely. The stock price of American Express was sliced in half, plunging from over $60 a share to $35. It was a moment of peak terror, but Warren Buffett, then a young, relatively unknown fund manager in Omaha, saw an opportunity. Instead of reading the panicked headlines, he decided to do his own primary research. He went out into the field to see if the scandal had actually damaged the company's core business. He visited restaurants and hotels. He talked to travel agents. He observed customers. What he found was that nothing had changed. Diners were still proudly slapping their green American Express cards on the table to pay for meals. Travelers were still buying travelers' checks with complete confidence. The scandal, as big as it was in the financial world, had not breached the walls of the company's brand. The name American Express was a promise of integrity, security, and prestige, and that promise was so powerful in the minds of its customers that it transcended the news of a problem in some obscure warehousing division. The moat was intact. Convinced of this, Buffett made an audacious move. He invested 40% of his entire investment partnership's capital into American Express stock. It was a massive, concentrated bet. Over the next few years, as the company settled the legal claims for a fraction of what was feared and its core business continued to thrive, the stock price soared. The investment was a grand slam, cementing Buffett's reputation as a brilliant investor. What he had recognized was that the company's true value wasn't in its warehouses or its office buildings. It was in the trust and prestige associated with its name. That brand was the unbreachable moat that protected its profitability, and he was able to buy that fortress at a time when everyone else was fleeing in terror. The psychological power that underpins a moat like the one American Express possesses is rooted in deep-seated cognitive biases, primarily social proof and brand trust. As humans, we are wired to make decisions by looking at what others are doing. This is the principle of social proof. When we see other people using a product or service, especially people we perceive as high status, our brain takes a shortcut. It assumes that if they are using it, it must be good and safe. In the 1960s, the American Express card was a powerful status symbol. Pulling one out of your wallet signaled that you were a person of means and creditworthiness. This created a self-reinforcing loop. The more high-status people used the card, the more other people wanted one, further strengthening the brand's exclusive appeal. This is a moat that is incredibly difficult for a new competitor to cross. You can't simply create a prestigious brand overnight. It has to be earned through years or even decades of consistent performance and careful marketing. Closely related to this is the concept of brand trust. Our brains are constantly seeking to reduce uncertainty and cognitive load. When we find a brand that has consistently delivered on its promises, we latch onto it. We stop re-evaluating the decision every time we make a purchase. Think about buying a can of Coca-Cola. You don't perform a chemical analysis or read online reviews every time you're thirsty. You trust that it will taste the same as it always has. This trust is a massive asset. American Express had built up decades of trust with its travelers' checks. That trust was transferable to its new charge card product. The salad oil scandal was a threat to this trust, but as Buffett discovered, the reservoir of goodwill was so deep that it could withstand the shock. This phenomenon is also connected to the Lindy effect, a concept which posits that the future life expectancy of a non-perishable thing, like a technology or an idea, is proportional to its current age. The longer a brand like American Express or Coca-Cola has been around, the more it has been tested by recessions, wars, scandals, and competition, and the more likely it is to survive into the future. Time, in essence, deepens the moat. Competitors come and go, but the brands that have become part of the cultural landscape possess a staying power that is almost impossible to replicate. Recognizing the existence of a moat is one thing. Being able to systematically identify and categorize different types of moats is a skill that separates the amateur investor from the professional. To achieve a CEO mindset in your stock analysis, you need a framework. Let's call it the Moat Identification Matrix. This matrix breaks down durable competitive advantages into 5 primary categories. By running a company through this matrix, you can determine the nature and strength of its defenses. First is the asterisk brand moat asterisk, which we saw with American Express. Ask yourself, is this a brand that customers are willing to pay a premium for, or one they trust implicitly over cheaper alternatives? Think of Apple, Nike, or Tiffany & Co. Their names alone command pricing power and customer loyalty that generic competitors simply cannot match. Second is the asterisk switching cost moat doubt. This exists when it is a significant pain, either in terms of time, money, or effort, for a customer to switch to a competitor. Think about your primary bank. Moving all your automatic payments, direct deposits, and linked accounts to a new bank is a massive headache, so you probably stick with your current bank, even if a new one offers a slightly better interest rate. Enterprise software companies like Microsoft or Oracle are masters of this. Once a corporation has built its entire workflow around their systems, the cost and risk of switching are astronomical. Third is the asterisk anti-network effect moat. This is one of the most powerful moats, and it occurs when a product or service becomes more valuable as more people use it. The classic example is a credit card network like Visa or MasterCard. The more merchants that accept Visa, the more useful it is for consumers. The more consumers who carry Visa, the more essential it is for merchants to accept it. It's a virtuous cycle that locks out new competitors. Social networks like Facebook and professional networks like LinkedIn operate on the same principle. Fourth is the asterisk cost advantage moat. This is when a company can produce its product or service at a sustainably lower cost than its rivals. This can come from proprietary technology, unique access to a raw material, or, most commonly, immense scale. A company like Walmart or Costco can negotiate better prices from suppliers than a small local store because they buy in such massive quantities. Geico has a cost advantage over traditional insurers because its direct-to-consumer model bypasses the need to pay commissions to agents. Finally, there is the regulatory or patent moat. This is when the government actively prevents competition. A utility company is often granted a legal monopoly over a specific geographic area. A pharmaceutical company that develops a new drug receives a patent that gives it exclusive rights to sell that drug for many years. Credit rating agencies like Moody's and S&P have a regulatory moat because their ratings are embedded in financial regulations. By systematically evaluating a company against these 5 moat types, you can build a detailed picture of its competitive position and the durability of its future profits, a crucial step in any serious wealth management strategy. To truly appreciate the fortress-like security of a business with a wide moat, we must examine the graveyard of companies that had none. The antithesis of owning a moated business is the myth of the first mover. It's a common misconception in business and investing that the first company to enter a new market will inevitably be the winner. In reality, being the first mover is often a curse. The first mover has to spend enormous sums of money educating the market, figuring out the right business model through trial and error, and building out the initial infrastructure. Then, once the market is proven, a fast follower can swoop in, copy what works, avoid the mistakes of the pioneer, and often, with a better cost structure or a more resonant brand, steal the entire market. The history of technology is a brutal testament to this fact. Does anyone remember the first social network, 6 Degrees, or its more famous successor, Friendster? Friendster was a phenomenon in the early 2000s, accumulating millions of users. But it was slow, buggy, and had no real moat. Facebook came later, offering a cleaner interface and a more robust platform, and leveraged the network effect of the exclusive college communities it started in. It learned from Friendster's mistakes and built an unbreachable network effect moat that Friendster never could. Friendster is now a historical footnote. Similarly, in the world of online search, AltaVista and Lycos were dominant players long before Google existed. But they cluttered their pages with ads and portals, while Google focused on one thing: providing the best, fastest, and most relevant search results. Google's superior algorithm was a form of proprietary technology moat that, combined with its clean brand, allowed it to completely obliterate the first movers. This pattern repeats in almost every industry. The market is littered with the arrows of the pioneers. The average investor, caught up in the hype of a new industry, often makes the mistake of betting on the first mover, assuming they will be the ultimate victor. They are betting on a company that is doing all the hard work, but has no defenses to protect its future profits. A Buffett-style investor waits. They wait to see how the industry develops. They wait to see which company builds a real, durable moat. They would rather be late and right than early and wrong. They understand that in the game of long-term investing, it's not who starts the race that matters, but who has the stamina and the defenses to finish it. The presence of a strong moat has a direct, quantifiable, and beautiful impact on a company's financial performance. It is the secret ingredient that allows a good company to become a great long-term investment. The single most important metric for identifying a moat through financial statements is return on invested capital, or ROIC. ROIC measures how much profit a company generates for every dollar of capital that has been invested in the business. Think of it as the company's internal rate of return. A company with no moat, operating in a highly competitive industry, might struggle to earn a return on its capital that is higher than its cost of capital. In effect, it's treading water. All its profits are competed away. A company with a wide, unbreachable moat, however, can consistently generate very high returns on its capital, year after year, decade after decade. This is because the moat protects it from the forces of competition that would normally drive those returns down. When you are doing your stock analysis, look for a company that has a long history, 10 years or more, of consistently high and stable ROIC, preferably well above 15%. This is the financial fingerprint of a durable competitive advantage. This high ROIC is the engine of value creation. A company that can reinvest its earnings back into its business at a high rate of return will compound its intrinsic value at a spectacular pace. This is how portfolio growth is truly achieved on a grand scale. Furthermore, the moat allows for financial stability. A company like Microsoft, with its massive switching cost moat in its Windows and Office products, doesn't need to take on huge amounts of debt to fend off rivals. Its profits are protected. This results in a much stronger balance sheet, with more cash and less debt, making the company far more resilient during economic downturns. For an investor, this means less risk and more peace of mind. A portfolio filled with high ROIC, moated businesses is not just poised for growth, it is built to withstand storms. It's a collection of financial fortresses, each one protected by deep, wide moats, ensuring that the profits generated inside belong to the owners, not to an endless stream of new competitors. This is the mathematical reality of monopoly investing. Having a toll bridge that is both essential and protected by a moat is wonderful, but the ultimate goal is for that bridge to produce a tangible, spendable return for its owners. This brings us to the third pillar, the predictable toll collector. This is the principle that focuses on the actual output of the business, the relentless, predictable, and growing stream of cash it generates. The greatest business in the world is worthless to an investor if it doesn't produce cash. Earnings can be manipulated with accounting tricks, but cash is reality. And there is perhaps no greater physical manifestation of a cash-generating toll bridge in the modern economy than America's railroads. In 2009, in the midst of the great financial crisis, Warren Buffett made the largest acquisition of his career. Berkshire Hathaway bought the Burlington Northern Santa Fe Railway, or BNSF, for $44 billion. He called it an, quote, all-in wager on the economic future of the United States. On the surface, railroads seem like an archaic 19th century business, but Buffett saw them for what they truly were: an irreplaceable artery of the American economy. BNSF and its primary competitor, Union Pacific, form a duopoly on freight rail transport west of the Mississippi River. They are, quite literally, two giant toll bridges that span the continent. Think about what they move. The grain from the Midwest that feeds the world, the coal that powers our cities, the shipping containers filled with consumer goods that arrive from Asia and need to be distributed to every corner of the country. Transporting these goods by rail is 4 times more fuel efficient than transporting them by truck. For heavy, long-haul freight, there is no viable alternative. The essentiality is absolute. The moat is equally formidable. The cost to replicate BNSF's 32,500 miles of track would be in the trillions of dollars, and securing the land rights would be a political and legal impossibility. It is a moat of pure physical reality. But the most beautiful part of the business, from an investor's perspective, is the cash flow. Every time a train moves a container from one point to another, a toll is collected. This happens thousands of times a day, every day of the year. The revenue stream is immense, predictable, and grows with the overall economy. It's a business that requires significant capital to maintain its tracks and locomotives, but once those expenses are covered, the remaining cash that gushes out is staggering. BNSF is a machine that turns economic activity into cash for its owner, Berkshire Hathaway. It doesn't rely on flashy new technology or fickle consumer trends. It relies on the fundamental, ongoing need to move physical things from where they are to where they need to be. It is the ultimate predictable toll collector, a perfect engine for generating reliable cash flow that can then be used for wealth management and reinvestment in other great businesses. The psychological comfort that comes from owning a business with predictable cash flow cannot be overstated. It directly counters a powerful and destructive cognitive bias known as ambiguity aversion, or the certainty bias. Our brains are wired by evolution to prefer known risks over unknown risks. We crave certainty and predictability. The world of investing, particularly in high-growth speculative stocks, is a world of extreme uncertainty. Will this new drug get FDA approval? Will this new app go viral? Will this company ever become profitable? The mental energy and stress involved in holding these types of investments are enormous. This uncertainty often leads to poor decision-making, like panic selling at the first sign of trouble, or holding on to a loser for too long in the desperate hope it will turn around. A business like BNSF, on the other hand, is a balm for the investor's soul. While its earnings will fluctuate with the business cycle, there is a very high degree of certainty that 10 years from now, BNSF will still be a critical part of the U.S. economy, generating substantial amounts of cash. This predictability is the foundation of true financial freedom. It allows for rational, long-term planning. You can have a reasonable degree of confidence in the future income stream your portfolio will generate, allowing you to plan for retirement, fund your children's education, or pursue entrepreneurial ventures without the constant anxiety that your capital might evaporate overnight. Owning cash-gushing, predictable businesses shifts your entire mindset from a state of fear and greed to a state of calm, patient ownership. You stop checking the stock price every day because you are confident in the underlying business's ability to continue collecting its tolls. This emotional stability is one of the most underrated but most valuable assets an investor can possess. It allows you to ignore the noise of the market and focus on what truly matters, the long-term cash-generating power of the assets you own. To truly become a master of your own financial destiny, you must learn to speak the language of cash. Reported earnings, or net income, the number you see celebrated on financial news shows, can be misleading. Accounting rules allow for all sorts of non-cash charges and adjustments that can obscure the true economic reality of a business. To see the business as an owner would, you need to use a mental model that Buffett himself champions, the calculation of owner earnings. This is the blueprint for understanding a company's real cash-generating power. The calculation is a simple, 4-step process. Step 1. Start with the company's reported net income. This is your baseline. Step 2. Add back all non-cash charges. The most common of these are depreciation and amortization. These are accounting expenses that are meant to represent the gradual wearing out of assets, but they don't involve an actual outlay of cash in the current period. Adding them back gets you closer to the cash the business actually produced. Step 3, and this is the most important and nuanced step. Subtract the average annual amount of capital expenditures, or CapEx, that the business needs to spend just to maintain its current competitive position and unit volume. This is called maintenance CapEx. A company has to spend money on new machinery, technology upgrades, and facility repairs just to stay in the same place. This is a real cash cost that is necessary for the business's survival. The key here is to use an average over several years, say 5 to 7 years, to smooth out any lumpy one-time projects. Step 4. The number you are left with is owner earnings. This figure represents the real, discretionary cash that the business generated in a year. It's the cash that management could, in theory, pull out of the business and hand to the owners without harming its long-term prospects. This is the ultimate metric for a retail investor or entrepreneur. It is the true toll collected. By learning to perform this simple stock analysis, you move beyond the headlines and gain a much deeper, more accurate understanding of a business's health and value. It is the first step toward making investment decisions based on economic reality, not accounting fiction. The path of the 99%, in stark contrast, is to be seduced by the siren song of growth at any cost. This is the prevailing philosophy in many parts of the market, particularly in the venture capital and tech sectors. The model is simple: acquire users and revenue as fast as possible, and don't worry about profits or cash flow. The promise is that once the company achieves massive scale, it can flip the switch and become profitable. This is a dangerous and often fatal narrative. The quintessential example of this flawed thinking is the rise and fall of WeWork. The company had a charismatic founder and a grand vision to revolutionize office space. They offered beautiful, flexible workspaces and a sense of community. The growth was explosive. They expanded to hundreds of locations around the globe, and their private valuation soared to an eye-watering $47 billion. They were celebrated as the future of work. But beneath the surface, the business was a house of cards. They were hemorrhaging cash. Their business model involved signing long-term leases on expensive real estate and then renting it out on a short-term basis. They were spending billions on lavish build-outs and marketing to fuel their growth. In the first half of 2019 alone, they burned through over $2 billion in cash. Their survival was entirely dependent on their ability to raise more and more money from investors who believed in the growth story. They had negative owner earnings. They weren't collecting tolls. They were paying people to cross their bridge. When they finally tried to go public and their financial statements were exposed to the harsh light of day, the narrative shattered. The IPO was canceled, the CEO was ousted, and the valuation plummeted by over 90%. Investors who had bought into the growth at any cost story were decimated. This is the danger of ignoring cash flow. A business that does not generate cash is not a business. It is a science project. Its existence is subject to the whims of the capital markets. When investor sentiment is bullish and money is cheap, these companies can survive and even thrive. But when the tide of capital goes out, as it always does, they are left exposed, with no internal engine of cash generation to sustain them. They are the financial equivalent of a marathon runner who is trained by sprinting for the first mile. The collapse is inevitable. The direct financial connection between a focus on predictable cash flow and your long-term wealth is the most powerful force in finance: compounding. Cash flow is the lifeblood of a business and the fuel for shareholder returns. When a company consistently generates more cash than it needs to maintain its operations, it has several options for what to do with that excess cash, all of which can benefit you as an owner. It can be used to pay a dividend, which is a direct cash payment into your brokerage account, providing you with a stream of passive income. It can be used to buy back its own shares. This is an often misunderstood but powerful way to increase your ownership stake. When a company reduces its number of shares outstanding, your percentage ownership of the business goes up without you having to invest another dollar. It can also be used to make smart, bolt-on acquisitions that strengthen its moat and increase its future cash-generating power. Finally, and most powerfully, it can be reinvested back into the core business to fund organic growth projects, as long as those projects can earn a high rate of return. The key financial statement to master here is the statement of cash flows. On it, you will find a line item called free cash flow, FCF, which is a close proxy for the owner earnings we calculated. What you want to see is a long history of positive and growing free cash flow. You can also calculate the free cash flow margin, which is the company's FCF divided by its revenue. A consistently high FCF margin, say above 10 to 15%, is a sign of a highly efficient, cash-generative business model. This relentless stream of cash is what drives the compounding machine. It's the tangible result of owning a predictable toll collector. A portfolio built around these types of businesses doesn't rely on hope or speculation. It is built on the mathematical certainty that owning assets that gush cash will, over time, make you incredibly wealthy. Even a perfect toll bridge, essential, moated, and gushing cash, can be a poor investment if the toll collector is a fool or a scoundrel. This leads us to the fourth pillar, the rational toll price. This encompasses two critical ideas: the company's ability to raise its prices without losing customers, known as pricing power, and the wisdom of its management in allocating the capital the business generates. A brilliant business run by an incompetent or self-serving CEO can destroy immense value. A good business run by a brilliant capital allocator can become one of the greatest investments of all time. There is no better case study for this than Buffett's most famous investment, the Coca-Cola Company. Everyone knows the story of Coke's dominant brand moat. It's an essential, habitual purchase for millions around the world. But the real magic of the investment lies in the combination of its pricing power and a period of extraordinary leadership. For decades, Coca-Cola has been able to implement tiny, almost imperceptible price increases on its products year after year. A penny here, a nickel there. For the consumer, the increase is negligible. They are anchored to the price of a Coke being about a certain amount, and they will happily pay a little more for the brand they love. But when you multiply that tiny price increase by the billions of servings the company sells every day, the impact on profits is astronomical. This pricing power is a direct result of the moat and is one of the most valuable assets a business can have. It allows the company to offset inflation and consistently grow its earnings. However, this pricing power would have been far less valuable without the genius of the man who ran the company from 1981 to 1997, Roberto Goizueta. Before Goizueta, Coke's management had become somewhat complacent. They were sitting on a great asset, but weren't maximizing its value for shareholders. Goizueta arrived with a clear, focused mission to increase shareholder value. He understood that his job was not to run the day-to-day operations of bottling plants, but to be a master capital allocator. He sold off underperforming assets and focused the company on what it did best, selling syrup concentrate, an incredibly high-margin business. He used the massive cash flows generated by the business, not for wasteful diversification into unrelated industries, a common mistake he derided as diversification, but to aggressively buy back the company's own stock and increase its dividend. He understood that the best investment Coca-Cola could make was often in itself. This combination of a business with incredible pricing power and a CEO with a shareholder-focused, rational approach to capital allocation created a supernova of value creation. During Goizueta's tenure, the market value of Coca-Cola exploded from $4 billion to $145 billion, delivering one of the greatest investment returns in corporate history. The psychological principles that allow a company like Coca-Cola to execute this strategy are anchoring bias and the economic concept of inelastic demand. Anchoring bias is our tendency to rely heavily on the first piece of information offered when making decisions. For Coke, the anchor is the price we've been accustomed to paying for years. When the price increases by a small percentage, our brain compares it to the anchor price and perceives the change as minor and acceptable. We don't reevaluate the entire purchase from scratch. We simply adjust our anchor slightly upwards. This allows for the steady, incremental price increases that are so powerful over time. This is only possible because the product itself enjoys highly inelastic demand. As we discussed with See's candies, this means that changes in price have a relatively small effect on the quantity demanded. For a loyal Coca-Cola drinker, there is no true substitute. Pepsi is not the same. A generic store-brand cola is certainly not the same. The unique taste, combined with the powerful brand associations built over a century of marketing, creates a psychological monopoly. The customer is not just buying a carbonated beverage, they are buying a moment of refreshment, a taste of nostalgia, the real thing. This emotional connection short-circuits the rational price comparison part of our brain. This is the holy grail for any business, a product that customers feel they must have, for which they will tolerate gradual price increases without complaint. On the management side, the psychology of a great capital allocator like Roberto Goizueta is one of extreme rationality and a focus on long-term value over short-term ego. This is exceptionally rare. The typical CEO is driven by a desire to build a bigger empire, often leading to a focus on revenue growth over profitability and a penchant for flashy, headline-grabbing acquisitions. A rational allocator, by contrast, is driven by a detached, mathematical focus on maximizing the per-share intrinsic value of the business. They are able to resist the social pressure to do something with the company's cash and have the patience to wait for truly great opportunities, whether that is reinvesting in the core business or buying back shares at an attractive price. They think like an owner, not like a manager. To consistently identify companies led by rational, owner-focused managers, you need a mental model that goes beyond just looking at the numbers. You need the capital allocation test. This is a qualitative assessment of management's track record and mindset. It has three primary components. First, you must act like a historian. Review the company's major capital allocation decisions over the past 5 to 10 years. Read their annual reports. What did they do with their free cash flow? Did they reinvest it in the core business? If so, what were the returns on that investment? Did they make acquisitions? If so, were those acquisitions synergistic and within their circle of competence, or were they expensive forays into unrelated fields? Did they buy back shares? Crucially, at what valuation did they buy them back? Buying back overvalued stock destroys value just as surely as a bad acquisition. Did they pay a dividend? Was it a sensible, sustainable amount, or were they borrowing money just to maintain it? This historical review will give you a clear picture of their decision-making process. Second, you must become a psychologist. Read the CEO's annual letter to shareholders. This is often the most important document a company produces. Does the CEO write with clarity and honesty, admitting mistakes and explaining their thought process in plain language? Or is the letter filled with corporate jargon, buzzwords, and self-congratulatory nonsense? The best letters, like those written by Warren Buffett himself, sound like a partner in a business talking to his other partners. They are educational, transparent, and focused on the long-term health of the business. This is the CEO mindset you are looking for. Third, you must be a financial detective. Look at the company's executive compensation structure. Is the CEO's bonus tied to metrics that actually create shareholder value, like growth in owner earnings per share or return on invested capital? Or is it tied to vanity metrics like revenue growth or the sheer size of the company? A well-designed compensation plan aligns the interests of management with the interests of the owners. A poorly designed one encourages empire building and other value-destructive behaviors. By applying this three-part test, you can develop a deep understanding of the quality and rationality of the management team, which is often the deciding factor between a mediocre investment and a truly great one. The antithesis of the rational capital allocator is a figure all too common in the corporate world, the empire builder CEO. This is the executive whose primary motivation is not to maximize per-share value for the owners, but to increase the size, prestige, and power of the company, and by extension their own personal influence and compensation. Their ego is inextricably linked to the scale of the enterprise they command. These CEOs are addicted to making deals, particularly large, transformative acquisitions that put their face on the cover of business magazines. They fall in love with flawed concepts like synergy, strategic fit, and, quote, redefining the industry, using this vague language to justify paying enormous premiums for other companies. The most infamous example of this value-destructive behavior is the disastrous 2000 merger of America Online, AOL, and Time Warner. At the time, AOL was the king of the new media internet world, and Time Warner was a titan of old media, owning properties like CNN, Warner Brothers, and Time magazine. The rationale for the merger was that it would create an unbeatable vertically integrated media and internet powerhouse. The CEO of AOL, Steve Case, and the CEO of Time Warner, Gerald Levin, were hailed as visionaries. But it was a deal driven by hubris and a fundamental misunderstanding of both businesses. They were trying to smash together two completely different corporate cultures. The promised synergies never materialized. The dot-com bubble burst shortly after, and the value of the AOL division plummeted. The merger, which was the largest in U.S. history at the time, resulted in a staggering $99 billion write-down just 2 years later. It was an epic failure of capital allocation, a monumental destruction of shareholder wealth driven by the empire-building ambitions of its architects. Investors who owned Time Warner stock, which was a collection of wonderful moated media assets, saw their investment decimated because the company's leadership decided to trade it for a fleetingly popular internet company with no real moat at the absolute peak of a speculative bubble. This is the ultimate danger of investing alongside an empire builder. They will take the cash generated by a perfectly good toll bridge and use it to buy a fleet of leaky, overpriced boats, sinking the entire enterprise in the process. The financial signature of a company with great pricing power and rational capital allocation is clear and compelling. It is the secret to unlocking exponential portfolio growth. The first place to look is at the trend of the company's profit margins. A company with true pricing power can consistently expand its operating and net profit margins over time. As they pass along inflationary costs and then some to their customers, a larger percentage of each dollar of revenue falls to the bottom line. This is a clear indicator that they control their market, rather than being controlled by it. Next, you can measure the direct returns to owners by calculating what is known as shareholder yield. This is a powerful metric that combines the company's dividend yield with its buyback yield, the percentage of its market cap it spent on repurchasing shares. A company with a high shareholder yield is actively and efficiently returning its cash to its owners. This is a hallmark of a management team that is focused on shareholder returns rather than empire building. But perhaps the most telling long-term metric is a consistently high return on equity, or ROE. ROE measures how much profit the company generates for every dollar of shareholders' equity on its balance sheet. A company like Coca-Cola has historically maintained a very high ROE. This shows that it can take the earnings it retains and reinvest them at a very high rate of return. However, it's crucial to check that this high ROE is not being artificially inflated by taking on huge amounts of debt. A high ROE with a strong balance sheet is the ultimate sign of a well-managed, dominant business. When you find a company that exhibits these characteristics, expanding margins, a high shareholder yield, and a consistently high ROE without excessive leverage, you have likely found a business that not only has a great toll bridge, but is also run by a toll collector who knows exactly how to make you, the owner, rich. We have now identified the 4 key characteristics of a toll bridge business. It must be essential, protected by a wide moat, gush predictable cash, and be run by rational, shareholder-oriented management. But there is one final, crucial element that ties everything together. It is not a characteristic of the business itself, but a characteristic of the investor. It is the fifth and final pillar, the bridge builder's patience. This is the doctrine of generational ownership. You do not buy a great toll bridge with the intention of flipping it next month or next year for a quick profit. You buy it with the intention of holding it for decades, allowing the tolls to accumulate and the power of compounding to work its magic. The entire philosophy is rendered useless without the discipline to hold on. This principle is less about a single transaction and more about the entire arc of Warren Buffett's career. His favorite holding period, as he has famously stated, is forever. He has owned shares in companies like Coca-Cola and American Express for more than 30 years. He still owns the original shares of See's Candies he bought in 1972. This long-term perspective is not a matter of laziness. It is a matter of profound financial wisdom. He learned this lesson the hard way at a very young age. At the tender age of 11, in 1942, a young Warren Buffett made his first stock purchase. He bought 3 shares of a company called Cities Service Preferred for about $38 a share. He watched the stock nervously as it promptly fell to $27. He held on with white knuckles until it recovered back to $40, at which point he immediately sold, locking in a small profit of $5 for his 3 shares. He felt the thrill of a successful trade. But his excitement quickly turned to agony as he watched Cities Service continue to climb, eventually soaring to over $200 a share. The $5 profit he had been so proud of would have turned into a gain of nearly $500 if he had simply done nothing. The lesson was seared into his young mind. Short-term activity and emotional decision-making are the enemies of great returns. True wealth is not built by trading. It is built by owning great assets over very long periods of time. That early, painful mistake shaped his entire investment philosophy, transforming him from a would-be speculator into the world's greatest long-term owner. The psychological forces that Buffett's doctrine of patience is designed to combat are perhaps the most powerful and self-destructive biases in the entire field of behavioral finance. The first is myopic loss aversion. This is the scientifically proven fact that humans feel the pain of a loss approximately twice as powerfully as they feel the pleasure of an equivalent gain. Losing $100 feels as bad as gaining $200 feels good. This asymmetry makes us incredibly risk-averse in the short term. When we see our portfolio go down during a market correction, the pain we feel is intense, triggering a fight-or-flight response. The overwhelming impulse is to sell, to make the pain stop. This causes investors to systematically buy high in times of euphoria and sell low in times of panic, the exact opposite of what they should be doing. The second powerful bias is hyperbolic discounting. This is our tendency to prefer smaller, immediate rewards over larger, delayed rewards. We would rather have $10 today than $20 a year from now, even though the rational choice is to wait. This bias is what drives our desire for instant gratification. In investing, it manifests as the constant temptation to chase short-term trades, to scalp small profits, and to constantly be, quote, doing something. The idea of buying a stock and holding it for 10 years seems impossibly boring and slow to a brain wired for immediate feedback. Buffett's entire strategy is a conscious, disciplined override of these self-destructive mental shortcuts. His "our favorite holding period is forever" mantra is an antidote to myopic loss aversion. It reframes market downturns not as a source of pain, but as an opportunity to buy more of a great business at a cheaper price. His focus on the long-term compounding of value is a direct rejection of hyperbolic discounting. He is willing to forego the small, immediate thrill of a trade for the life-changing, massive reward of decades of uninterrupted growth. Mastering this psychological fortitude is the final and most difficult step in becoming a true, long-term investor. To cultivate this essential patience in your own investment practice, you need a powerful mental model that shifts your perspective from that of a stock renter to that of a business owner. This is the 10-year test. It is a simple but profound question you must ask yourself before you purchase a single share of any company. Would I be happy to own this business if the stock market were to shut down for the next 10 years? This question instantly changes the entire frame of your analysis. It makes the daily, meaningless fluctuations of the stock price completely irrelevant. You are no longer thinking about whether the stock will go up next week or next month. You are forced to think about the fundamental, long-term economics of the business itself. To answer the question, you must have a high degree of confidence in the durability of the company's moat. Will this business still have a competitive advantage 10 years from now? You must think about the long-term prospects of the industry. Is this a growing industry, or one that is in terminal decline? You must have faith in the quality and integrity of the management team to navigate the challenges and opportunities that will inevitably arise over the next decade. And you must believe that the business will be generating significantly more owner earnings in 10 years than it is today. Applying the 10-year test forces you to do the deep, fundamental research required for true long-term investing. It filters out the speculative, story-driven stocks and focuses your attention squarely on high-quality, durable enterprises. It transforms your relationship with your portfolio. You are no longer a nervous speculator watching a screen. You are a patient, partial owner of a collection of wonderful businesses, content to let them work their magic on your behalf over the long haul. This is the very essence of building stable investments for lasting financial freedom. The path of the 99% is, once again, the polar opposite. It is the frantic, high-stress world of the day trader and the high-frequency speculator. This is the person who is glued to multiple computer screens, watching charts, technical indicators, and the constant flow of financial news. They believe they can outsmart the market by predicting its short-term movements. They trade on rumors, on earnings whispers, on fleeting momentum. Their holding period is not 10 years, it is often 10 minutes. This path is almost mathematically guaranteed to lead to financial failure for several reasons. First, they are fighting a losing battle against transaction costs. Every time they buy and sell, they pay a commission. More importantly, every time they lock in a short-term gain, they are hit with a massive tax bill at their highest marginal rate. These two factors, commissions and taxes, act as a constant, grinding headwind that makes it incredibly difficult to come out ahead. Second, they are competing against an army of supercomputers and PhDs in quantitative finance who are doing the same thing, only thousands of times faster and more efficiently. A retail day trader trying to beat the market's high-frequency algorithms is like a person on a bicycle trying to win a race against a fighter jet. Third, and most importantly, they are making themselves a slave to their own worst emotional impulses. The constant exposure to the market's volatility puts them in a perpetual state of fight or flight. They are constantly battling the fear of loss and the greed for quick profits, leading to a cascade of irrational decisions. The stress, the anxiety, and the inevitable financial losses take a devastating toll not just on their portfolio, but on their overall well-being. It is a path of constant action, constant stress, and, for the vast majority, constant failure. It is the ultimate rejection of the calm, patient, and profoundly profitable path of the bridge builder. The direct financial connection of patience is the most beautiful and powerful force in the universe of finance, the magic of compounding. It is the engine that transforms a modest sum of money into a life-altering fortune. Let's use a simple, concrete example. Imagine you invest $10,000 into a great toll bridge business that is able to grow its intrinsic value and consequently its stock price at an average rate of 12% per year, a reasonable expectation for a high-quality, moated enterprise. If you were a short-term trader, you might get excited by a 12% gain in a year, sell the stock, pay taxes on your $1,200 profit, and start looking for the next trade. Your net worth has barely moved. But if you have the bridge builder's patience, you simply hold on. After 10 years, your initial $10,000, without you adding another cent, would have grown to over $31,000. After 20 years, it would be worth nearly $97,000. After 30 years, it would be worth over $299,000. And after 40 years of patient ownership, your initial $10,000 investment would have blossomed into over $930,000. This is the exponential power of leaving your capital in a great business and letting it work, uninterrupted. The longer you hold on, the faster your wealth grows, as you begin to earn returns not just on your original investment, but on the accumulated returns as well. This is the great secret of all long-term wealth creation. It's not about finding a stock that will double overnight. It's about finding a great business that can compound its value at a healthy rate for a very, very long time, and then having the psychological fortitude to get out of the way and let it happen. Patience is not a passive act. It is the most active and powerful decision an investor can make. It is the final, indispensable key to unlocking a lifetime of financial success. You have just invested a significant amount of your time and attention, and in doing so, you have acquired a powerful new piece of mental hardware. The toll bridge framework is more than just an investment strategy. It's a complete filtering system for reality. It allows you to cut through the noise, the hype, and the complexity of the financial world, and focus on the simple, durable truths that underpin all long-term value creation. You now have the ability to look at any business and ask the right questions. Is it essential? Is it protected by a moat? Does it gush cash? Is it run by rational owners? And do I have the patience to hold it for the long term? This tool alone, if applied consistently, can protect you from the most common and costly mistakes that plague the average investor and put you on a path toward building a truly unshakable portfolio. But it is crucial to understand that Buffett's entire system is a network of interconnected mental models. Mastering one is a monumental first step, but it is not the complete picture. You have just learned how to identify the perfect, impenetrable fortress, the ideal business to own. This is the what to buy, but there is an equally critical parallel skill that you must master: knowing when to buy it. A wonderful business purchased at a foolishly high price can be a terrible investment. The greatest toll bridge in the world is not a good buy if you have to pay 100 years of its future earnings to acquire it. The missing link in your arsenal is the art and science of valuation, the discipline of calculating a business's true intrinsic value, and then having the patience to wait for the chaotic emotional market to offer it to you at a significant discount. The journey you are on is one of building a complete mental toolkit, an arsenal of models that, when combined, give you an almost unfair advantage. The piece you have just acquired is the targeting system, allowing you to identify world-class assets. The video that is now appearing on your screen is the next piece of that map. It is the key that unlocks the other half of the equation. It is the link that connects the identification of a great business with the execution of a great investment. It teaches you how to wait for what Buffett calls the fat pitch, that rare, perfect opportunity to swing for the fences with the odds stacked firmly in your favor. The question is no longer whether you can recognize a great business. You have that skill now. The real question is, do you have the discipline to master the final step? To learn how to value it correctly and wait patiently for the market to hand you the keys to the fortress for pennies on the dollar? The click you are about to make is not just to watch another video. It is a commitment to continue your ascent, to complete your mental arsenal, and to transform yourself into the kind of investor who doesn't just hope for success, but systematically engineers it. The next step of your journey is waiting.